Federal taxpayers may be entitled to deductions for ordinary and necessary expenses incurred while carrying on a trade or business. But what qualifies as being either a trade or business? The United States Supreme Court addressed this question in the 1987 case, Commissioner v. Groetzinger. For most of 1978, unemployed marketer Robert Groetzinger spent 60 to 80 hours each week placing bets on greyhound races. He gambled solely for his own account and won $70,000 on bets of $72,032. This means that Groetzinger realized a net gambling loss for the year of $2,032. Although he reported his net gambling loss on his 1978 tax return, he didn't factor that amount into his adjusted gross income or claim it as an itemized deduction. The Commissioner of Internal Revenue determined that the $70,000 in gambling winnings was additional income, and that Groetzinger could deduct his gambling losses up to that amount as an itemized deduction. The Commissioner further determined that Groetzinger was subject to the alternative minimum tax provisions of the Internal Revenue Code, as it stood in 1978. The reason was that portions of Groetzinger's gambling losses were taxable as items of tax preference. These determinations by the Commissioner resulted in a total tax deficiency of about $2,500 for Groetzinger. Groetzinger challenged the deficiency in the United States Tax Court. That court held that Groetzinger's gambling activity qualified as a trade or business. Thus, no part of his gambling losses was an item of tax preference for purposes of the minimum tax provisions. The Seventh Circuit affirmed, and the United States Supreme Court agreed to take the case.